So today we're going to take a slightly different format to talk about Palantir because some very important news came up this morning saying that Palantir has slightly missed its the expectation from the financial analysts. So as a result, the stock fell significantly from a already very low level. I previously mentioned that Palantir has so far maintained its level above $10, and now as we speak it's around $7. So before the news released, I had two scenarios in mind. Number one, the news are good. The financial market is kind of like convinced that the bullish run is going to come very soon, and then we're going to enter into a new phase, or the current phase continues. And in which case, I would say that it would be a very good idea to start looking for entry point. But now I have a feeling that we are in a third phase, which is essentially to wait for the market itself, not just the stock, but the market itself to correct back. When I was looking at the Nasdaq, so not just Palantir, but the entire what we like to call speculative or growth stocks, or the stocks of the future, like however you want to slice it, it's basically the kind of stock that valuation doesn't really matter, and what matters is what is the risk appetite of the market at the moment. And so far, I would say that the risk appetite isn't that great. In some of my videos before, I've mentioned that I was expecting some positive catalyst to occur by May the 9th. And that catalyst was maybe the end of conflict in the real world. And unfortunately, it hasn't really occurred, at least not in the sense that we expected. So this, combined with the downturn effect that's already going on, I think that the market is going to keep grinding lower, sometimes at a very fast pace, sometimes not so fast. And it's very curious to notice that the Nasdaq, Palantir, a bunch of other stocks, along with the crypto market, are falling almost at a similar pace. And by that I mean, it's almost like the same stock that we're looking at. Whereas it's not only not the same security, it's from different assets across different markets. So I think that this is representative of a market sentiment far more than what people think about Palantir's fundamentals. Actually, I want to say that this is very similar sometimes to what the growth stocks in general, in the sense that as soon as the projections miss by a little bit, people are going to assume the worst. And sometimes they don't even look at what's beneath like the first layer. For example, I remember recently covering a company where they had like a large operating loss because they had their goodwill being amortized. So for those who are not familiar with this term, essentially what it means is that you have an intangible asset somewhere. It could be a brand, a patent, a reputation premium, or anything that's like this. And this intangible asset decreased in value. That's all it means. It doesn't mean that a company lost that much in money. And despite this, the company's share took a nosedive. So I think that sometimes the market's capability to understand things is limited, or sometimes it's even misleading. But at the end of the day, the stock market functions with supply and demand. So if people are not buying as many shares as before, then the price is going to fall. It's almost mechanical. And then once this process begins, everything will just follow. So in a market like this, it's important to keep your head up and to be aware of what the market sentiment is, and also what is the environment telling you. Right now, the environment is telling me that the appetite for risk is decreasing, even lower than where it was before. And not based off, let's say, the price chart of Palantir, because we're now below a very significant and historical support level. I would say that people are looking at Nasdaq price progression since 2020 overall. They look at the state of the economy, they look at the business model of many of those companies, and then they realize that, well, you know what, at the end of the day, a lot of those companies kind of rely on a healthy real economy in order to operate. And the economy is not really in a healthy state, to say the least. Not to mention that sometimes is literally destroyed due to real world events. So this is why right now investors are looking for safer investments, and they're probably putting their money into reserve and wait for a better opportunity. So the better opportunity doesn't necessarily mean whether things have bottomed. Because first of all, unless we have some kind of inside information, which we don't, nobody knows where is the bottom for sure. And the other thing is, by definition, a bottom exists because it's now past us, right? So let's say the bottom was de facto historically $8. You know that this is a bottom maybe 3 months from now. Very few people can call a bottom right. And even though at the moment the price of Palantir and of many other stocks are at a historically low level, I think that we also have to look other things to determine if we should put our money in. The first indication is, what does this company do? Palantir analyzes data. It also analyzes data for big fish in this pond, or in the ocean for that matter. So it has clients with deep pockets, with deep relationships. We know that a co-founder, Peter Thiel, is not only someone who's very smart, someone with a farsight, but is also someone with a lot of contacts with the establishment. So this already gives us a sense of what Palantir aims to become. In my mind, it has always been in the league of Cerberus Capital and the Carlyle Group, in the sense that it's something that's going to last over time, and it's something that will have inherent and deep value for its investors. The thing is, most people won't be able to hold the stock till then, either because they likely don't have this kind of patience, or because their position is way too large for it to be sustainable over time. Like, let's say you have borrowed money or you have refinanced your house and bought into a few positions such as Palantir, Tesla, Lucid when the price was high. Well, guess what? When the price dips, at some point you're kind of forced to liquidate part of your position in order to pay back the interest, because otherwise you may lose something that's a lot more important than your position. In my personal case, Palantir is currently about 1%, and I'm considering to increase it to about 2% of my portfolio over the next 6 to 9 months. And I will probably use the dollar cost average tactic in order to wait out the short-term volatilities, even if I think that at this point, the negative volatility may also last for the medium term. This is why I'm saying over the next 6 to 9 months. Normally, I would recommend to buy most of the stocks that I actually covered because I do believe in them and I own most of them. At this point, though, I would say that don't put in all your chips in one shot and wait for better entry points. What I can see now is that the price is dipping. I'm not seeing a support yet. So this is why I would say wait for at least a week or two to see where the price is stabilizing at, and then add in your position from there. Personally, I would split my allocation in 5 to 10%, so I'm going to buy it in batches of like 20 times over the next 6 to 9 months to minimize the impact of near-term volatilities. I would personally recommend between 1 to 3% of your portfolio in the stock, and to split it in at least 10 batches of 10% each. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.